Morning, everybody. I'm Nick Brummer from Investonline, and joining me today is my fellow director, Stuart Dyer. We're doing our webinar today on offshore wrappers. This is a fantastic product for South African investors, which we highly recommend our clients to go into, and we're going to go through the details today. Investonline operates out of Newlands, Cape Town. We comprise 15 staff, 9 professionals and 6 admin. We're an independent financial advisory firm, and we provide financial planning and investment advice. Please enjoy this webinar. Stuart's going to go through the details, and then I'm going to have some questions for him. Thanks. Over to you, Stuart.
Well, thanks, Nick, and thank you to everyone for joining today. I know this has been a really in-demand topic, offshore wrappers, something we've had a lot of interest in over the last few years. So we're excited to go through some good content today. We're going to change the format a little bit from some of our past webinars. I'm not going to talk for too long. I'm just going to cover the key information around offshore wrappers in about 15 to 20 minutes. And then we had over 50 questions submitted at registration stage that we've selected 11 questions that Nick will basically pose to me, and we'll tackle live in the webinar. So just to go through the agenda, what is an offshore wrapper? Who should invest in an offshore wrapper? How to invest? The tax advantages and estate benefits, investment choices within the investment vehicle. I've just got a practical tax example we'll run through, and then as I've just mentioned, the live Q&A as well. So what is an offshore wrapper? I mean, essentially it's a type of investment vehicle that is held directly offshore, and it's invested in foreign currency. So there's a lot of investors in South Africa at the moment that are buying offshore instruments, but they're doing it through rand-based products, like feeder funds in the unit trust world, or you get ETFs and even instruments called ETNs in South Africa, where you're buying and tracking foreign indices, but you're doing it in rand-based products. So the offshore wrapper sits directly offshore, and you can invest into different investment instruments, but that money would be held outside of South Africa. It would be held in US dollars or other major currencies. The investment is fully SARS compliant, which we'll talk to you a little bit more. It's tax efficient. It's estate effective, which is really, really key when it comes to direct offshore investing, and I'm going to talk quite a bit about that. And there's a lot of investment options when you go directly offshore. The universe is really large, and we'll talk through what that looks like. So who should invest in an offshore wrapper? You're a South African individual or family, SA trusts or companies can also invest, and you're seeking the safety of direct offshore exposure that's not in rands. Generally, the minimum amount to open an offshore wrapper is $25,000, which is there or thereabouts, just below 500,000 Rand at the moment. And if you've got at least a medium to long-term investment horizon, I mean, you are able to access the wrapper, so you can invest for the shorter term, but generally this sort of investment should be for the longer term. If you've got UK or US shares or future UK-US exposure, and you're trying to mitigate the punitive situs or inheritance tax issues around the US and the UK, we're going to talk quite a lot in detail about that. And if you're looking for broad investment access and multi-currency flexibility. So how do you actually go about investing offshore if you haven't done it before? I think a large reason why a lot of investors are using rand-based instruments is that it's just so simple. They can just do it in their existing unit trust companies they invest with, or if you've got a stockbroking platform, you can buy the rand-based ones. But it's better to do it offshore, and we'll explain it why. So you can either externalize rands offshore, which means to now convert rands that you've got here and move that money offshore. Each individual is allowed 1 million Rand, what's called your single discretionary allowance per calendar year, where you don't have to get any tax clearance on that money. So you can invest up to 1 million Rand offshore, and a lot of people do this quite regularly, where they do the million rand, no questions asked. But you are allowed to apply for up to another 10 million rand per calendar year. And even we hear that, SARS does give clearance for more than 10 million rand. So you can technically do up to 11 million rand per year, and that's January through to December. And how it works is once you get that clearance, you have a year from getting it to actually take the money offshore. So you don't have to rush and convert your currency on that date you get the clearance. You have time to decide how you want to phase your money offshore and how you want to move it. Alternatively, and this is what we see quite regularly, is a lot of South Africans also have existing cash, or they have existing investments already in foreign currency outside of the country. You can actually sell these investments or transfer these investments to a wrapper account in your name. So you would either use your foreign cash and just do a bank transfer to a new wrapper account to open the wrapper, or if you've got existing shares or portfolios offshore, you can transfer those as well. The key issue is when you do transfer your shares, it is a sale, because you've got to take that fresh cash, whether that's dollars, euros, or sterling, or a mix, and you've got to reinvest that into a new wrapper account. So now into the crux of what the benefits of the wrapper is, or what the benefits are. First off is the tax advantages, and the product is completely SARS compliant. So I know a lot of people who have foreign investments maybe feel a little bit unsure what to disclose in their annual returns. With the wrapper, SARS is happy with the investment vehicle. It's essentially built for South African tax residents who want to invest directly offshore. And the way it works is that your investment grows over time, and as the investment triggers taxable events, such as you sell a fund or you sell a share that makes a profit, the institution that holds the investment on your behalf actually pays the tax to SARS directly at that stage. So the tax is paid on your behalf. You don't have to declare anything in your tax returns and pay anything to SARS. The vehicle essentially funds itself from a taxation perspective, very similar to how an endowment would within South Africa. As I've just mentioned, the tax is paid on your behalf under the five-fund system. And the tax rates that are used is 12% tax rate, and that's both on capital gains and income. And that's a little bit of a technical thing, because offshore what they do is they use roll-up funds, so you don't pay a higher tax rate on income, you pay a flat tax rate across capital gains and income. So 12% effective rate, and you only trigger that tax when you make those sales, if you sell the whole contract or portfolio, or if you trigger gains along the way. So you're not paying tax on an ongoing basis unless you trigger profits along the way. And the administration is extremely simple. You essentially have your contract. You can have different instruments within the contract, funds, passive funds, ETFs, whatever it may be. You don't have to declare anything in your annual tax returns. You actually don't even get IT3C or IT3B tax certificates. All you get is your annual valuation. But within that, you get an online account. You can log in. You can view your investments 24/7. And, there's nice ways you can see your performance chart. You can see your internal rate of returns. You can make fund changes if you like. So everything's fully transparent, and, you're able to see everything online. So all in all, very simple product with good tax treatment. Now, the big other issue is estate treatment. If you are someone who's got direct assets offshore, you essentially potentially are causing yourself to have an estate in those jurisdictions offshore where you're holding those assets. So those assets need to be wound up either as part of your SA estate or as part of your foreign estate in those jurisdictions. So when you have a wrapper allows you to nominate beneficiaries on the contract. And when you nominate those beneficiaries, when you pass away, the beneficiaries actually get the right to ownership of that offshore investment. So if you pass away, there's no executor that has to deal with the investment. the beneficiaries that you nominate, and whichever percentages you do it, they will take ownership of the contracts. Those contracts can stay offshore. They don't have to be brought back into rands. And I know that's a big attraction to a lot of investors, and this is why a lot of South Africans are using offshore wrappers. They don't necessarily want these larger investment portfolios that have generally been built up for a long time and are supposed to be part of generational wealth to now be paid out and paid in rands into, beneficiaries or dependents' bank accounts. So then the beneficiaries can take ownership of their offshore portfolios. They can keep the money offshore if they so choose, and they can choose when and how they want to withdraw. If they want to make withdrawals, in the future in their lives, they can do that because they're now the new owners of their part of the portfolios. Because the investment doesn't get wound up and it carries on after the death of the original investor, there's no executor that winds up the account, and you avoid foreign probate. So probate is basically executorship offshore. That's a European term in a lot of countries. So probate is where you need to appoint someone to represent your interests in that country, and they wind up your assets for you. Now, if you've got a wrapper, you don't have to worry about any of that, because a wrapper is registered as an SA Long-Term Insurance Act product, but it's built that it's directly offshore. And because you don't have a local executor or a foreign probate or foreign executor winding it up, you save executive fees. So local executive fees is up to 4% on the value of the assets. So on 10 million Rand, that's 400,000 Rand savings in executive fees potentially, as well as the foreign executor or probate would also charge fees. So you're saving those fees as well. So it becomes quite material, not having to have anyone have to handle that for you. And then when it comes to CGT, because the assets aren't sold on death and aren't paid out, and I think that's a key difference between an endowment, which a lot of people know in South Africa. An endowment acts like a life insurance policy that when you pass away, ordinarily the investment gets sold and the proceeds pays out to the beneficiary or beneficiaries. And at that point, there's a capital gains tax event that's triggered because investment stops. With a wrapper, which is actually a sinking fund, it doesn't cease to exist, it carries on, and that capital gains tax event doesn't get triggered. Only when your beneficiary, if it's your spouse or your children, whomever it may be, your trust, decides to invest in the future, then that CGT event or CGT events, if it's variance instruments, can happen. So with that, you get to delay CGT until you actually want to use the money, which is beneficial. So what are the investment choices within a wrapper product? So a wrapper is just a platform, the type of investment vehicle, and within that, there's a large investment universe. We use a few wrapper providers, but one of the main ones we use on their open platform, they have almost 400 funds and ETFs available. So they've got active funds. Active funds are like your Orbis or your Coronation or your 91, where you have fund managers actively deciding what to buy and sell. You also have passive funds and ETFs. So those are more cost-effective options where they track the index or a mix of indices. So there's quite a lot of passive options available, and normally a little bit cheaper than your active funds. There's geographic specific options. So you can invest in developed world funds, European index, US index, etc. Emerging market specific funds, both equities, bonds, credits, etc. And then you get quite a lot of specialist funds. So if you want to buy a Asia ex-Japan fund, you can get it. If you want to buy a tech fund or a healthcare fund, there's a lot of these different funds and ETFs available on the platform. And then these are just some of the select investment managers. We've just put some fund managers that we do include in our portfolios. How it normally works is we would obviously do an advice discussion with the clients or prospective clients, and we would come to agreement on how to build the portfolio around your risk profile, and we would have the offshore money fit part of your overall investment strategy and then select the underlying fund managers from there. So here's just a bit of a tax example that I'm just going to zoom in on briefly. I think this is a very powerful example. So what we have here is this is actually the same investment fund. I think it's the biggest, if not one of the biggest offshore funds in South Africa. So what we have in the middle column, which is called the indirect feeder fund, that's the local rand version of the fund. And what we have in the right-hand column is if you had to go and buy that same fund offshore within a wrapper. So the differences between locals, normally the local funds are a little bit more expensive because you've got to have the currency conversion as part of it. As well as in the local funds, you've got the weakness of the rand that's included in your taxable gain because you ultimately tax on your full rand growth over time. Whereas when you invest directly offshore, you only taxed on the US dollar or foreign currency gain, which is then converted back to rands. So it's a bit of a complex concept, but ultimately it just strips out a little bit of the rand weakness, which becomes material over a long time. So in this example, we're looking at 10 years, and this is real figures. If you invested in May 2015 with 10 million rand, you would have grown, if you bought the rand fund, to around 31.4 million rand, and 21.4 million rand of that would have been a capital gain. Your capital gains tax would have had to have been paid out of pocket, and we've assumed the marginal tax rate of 45% because of the size of the gain. So your effective CGT rate would be 18%. So that comes out to about 3.8 million rand in tax. So your outcome at the end of the investment, obviously the growth still looks fantastic, but your outcome after tax is 27.5 million rand. Now, if you had to have done the exact same investment, but done it offshore in a wrapper, you would have converted to dollars around $816,000. Your gain would have been $949,000, and you would have paid tax on the US dollar gain only. And you convert that gain to rands, it comes out at about 17 million rand. So instead of 21.4 million rand, which we see in the middle column, 17 million rand is a capital gain that you taxed on. And now you're going to pay tax at a rate of 12% and not 18% because you've got the preferential tax rate within the wrapper. So ultimately your tax becomes or lowers to 2 million rand. And your outcome after tax in your pocket is 29.7 million rand. So I can't stress this enough. This is the exact same fund. You have a rand version that you've bought as a feeder fund in your own name versus if you went and bought the US dollar version in a wrapper also that you would be the rights holder on. And you would have had almost 2.5 million rand more over a 10-year period. So, just a really good example of how the tax efficiency comes to life when you invest using a wrapper. So that's the end of me and going through the key content. So Nick, I believe you have some questions for me.
Yeah, good. Thanks, Stuart. A lot of detail, a lot to absorb there. And as Stuart said in the beginning, we had a lot of questions submitted, which we've selected 11 from, and we'll go through them. So first one here, as you can see up there, is what are the fees, the specific fees relating to a wrapper?
Good. Well, I think it's important to understand that a wrapper is a transparent investment product. There are no complex commissions. I know there's a lot of strange sounding products out there that some institutions sell around foreign pensions, etc. This is nothing like that. This is very similar to if you just had to go and buy a unit trust investment or a retirement annuity or anything in South Africa. So there are no upfront fees to invest. And then the ongoing fees really are determined by how much you invest and what underlying funds you choose to invest in. So total fees generally can be anywhere from as low as even 1% all in, and that includes advice, underlying investment funds, as well as the platform, or you can have fees above 2% depending if you choose to buy more specialist funds like some of the hedge funds or some of the active funds that we mentioned. So anything between around 1% up to 2% plus, but there are a number of factors. I mean, the product itself, the minimum fee on the higher end of the scale, if you have, just say the biggest, the scale ends at, let's say, £2 million and above, which is quite a meaningful amount, just under 50 million rand, that fee there is 0.2% per annum for the vehicle. So that's ultimately the cheapest it can be. If you have £2 million or below or above, the platform fee would be around 0.2%. And then you would add your investment fees on top of that.
Okay, thanks. I certainly think that's quite a good price for all the benefits you're going to get from the wrapper. Right, next question is, can you make withdrawals from an offshore wrapper? And what are the restrictions?
Good. Yeah. So technically, a wrapper has similar restriction rules to local endowments, but they're quite clever offshore in that they place your money into quite a number of underlying contracts on the back end that you don't really see. So you are restricted on how much you can withdraw in the first 5 years, which is the restriction period, but you technically allowed 1,000 withdrawals in that 5-year period. So we've never had anyone struggle with getting money out because no one's ever needed to make that many withdrawals. And then the normal Long-Term Insurance Act rules dictate that if you do want to do a full surrender or withdraw of the contract before the end of the 5-year period, there's normally a little bit of capital that you need to leave behind that needs to see out the restriction period. So that gets quoted depending on how long you've been invested for, how many months of the 5 years you've been invested for. And normally that's up to a maximum of 10%. So just an example, if you invest 10 million rand in the wrapper and 2 years in, you want to take your money and withdraw everything, you might have to leave 3, 4, 5%, maybe 400 or 500,000 rand in the policy. You can take the rest of what you've put in plus growth out, and the remaining amount will be available at the end of the 5-year restriction period for full withdrawal. And that's just to make sure that you see out the restriction period that the Long-Term Insurance Act dictates.
Right. Good one here. Fixed property. As a foreigner, you have a home overseas or holiday house. Can you put that in the wrapper?
So no, you can't put fixed property in the wrapper. Ultimately, because the institution holds the assets and pays tax on the assets need to be financial assets. They can't be fixed assets like property. So no, you can't put fixed property in a wrapper, unfortunately.
Right, interesting. Yeah, Shari'ah-compliant funds offshore, are they available, and how does it work?
Yeah, so you can have a Shari'ah-compliant offshore wrapper. It's not a separate product, it's the same product. Ultimately, you invest on the platform, and on the platform, there are Sharia global equity funds available, as well as, there's been quite a lot of good movement in the Sharia space, and they've even got some Sharia global ETFs now that track the Sharia global index. So we've got for our Muslim clients that want to invest directly offshore, you no longer have to use just Rand-based. You can also have the same wrapper benefits and have good Sharia global funds that you can invest into.
Right. Okay, so next question. What is the process for an overseas beneficiary to access the wrapper, and what are the tax implications for that person?
Okay, so now we're going to get a little bit into the meat of the technical side. So ultimately, you can have foreign beneficiaries on the wrapper policy. And what happens is, as I stated earlier, if you pass away, they take ownership of that policy. They're now the new owner, regardless of whether they're South African tax resident or not. But it's important to remember that the wrapper is created for South African tax residents and does pay tax to SARS when a taxable event is triggered. So often you would need to do a bit of an assessment, and we would do this with the beneficiaries, of whether it makes sense for them to keep the wrapper or not. In some cases, clients have children that are living overseas, but they still consider South Africa to be their home that they will return to one day, in which case it's probably fine to keep the wrapper because you can just keep growing the money offshore, not trigger any tax. And then when you bring you move back to South Africa in the future, you can withdraw the wrapper and start using it back here. And obviously SARS would get their tax at that point. But if you do live in a foreign country and you're not going to return, you probably would want to disinvest to your new home country and reinvest there, especially if you are, quite a lot of, young professionals are living in tax havens these days, Dubai, Cayman Islands, etc., that have low tax rates. Then you wouldn't want to be in the wrapper where you're paying 12% to SARS if you don't live here. So it really would be on a case-by-case basis, but, that would have to be assessed depending on where the new beneficiary lives.
Right, thanks. Interesting. Also here, you have your own investments offshore, including equities. This one, the New York Stock Exchange or the London Stock Exchange. What is the tax impact on death of a South African investor in these markets? I.e., so here your money is not in a wrapper, it's invested separately on these exchanges.
So this is really the key issue, is a lot of people have invested in foreign equities, maybe with one of the American or European banks or a combination, where they've got underlying shares that they own in foreign currency. And ultimately that causes you to have an estate in those jurisdictions. So in this case, the USA and the UK. So the tax implications on death are not friendly, particularly in the case of the US. So in the US, if you pass away with US equities and you're a South African tax resident, you're considered what they call a non-resident alien. And the threshold that you're allowed before you pay CITES, which is the US estate duty, is very low. It's around $60,000, which is just around R1 million. So if you've got more than R1 million invested in US equities, you're going to be in for potential CITES implications, which is estate taxes directly to America, that your state is going to be liable for. Now that tax rate is 40%. So if you've got a 10 million rand investment, that's 4 million rand that's potentially taxable there over and above the small threshold that they give you. So that's not a good outcome. In the UK, it's slightly more friendly, but not great. You're allowed £325,000 before you are entering the inheritance tax tables. So that's around 8 million rand that you're allowed before you have to pay tax or inheritance tax. But once again, that inheritance tax goes up to 40%. So our state duty in South Africa, which is the tax on assets on death, is 20% or 25% if you have an estate above 30 million rand. So the US and the UK is quite substantially higher tax rates on death than South Africa. So this is why, wealthy investors are using the wrapper. It's not just a tax efficiency in life. It's not just simplicity in life, but also in death. You don't have to have foreign executors wind up that money, and you avoid any stressful complications around the US or the UK tax authorities coming to you and asking for inheritance tax or CITES taxes as additional cash outflows from your estate, because we don't have friendly tax relations with them, particularly the US, around owning equities offshore.
Yeah, that's a big issue, that one. Thanks, Stuart. Yeah, well explained. Next one, is it necessary to have a separate will for any foreign financial investments? So if so, can such a will be prepared in South Africa, or must it be prepared in the foreign country?
Yeah, so that follows on nicely from the past question, Nick. I mean, ultimately, you can have one will speak to your worldwide assets, but it's not ideal to have that. So how that works practically, if you do have that, if you've just got a South African will or a worldwide will that covers everything you have, is that you're going to be left with a South African executor that doesn't have knowledge around foreign estate laws, who's going to be winding up everything. And they're going to have to appoint individuals in those jurisdictions where you've got other assets. Let's just say you've got a share portfolio in Switzerland at a Swiss bank, maybe a share portfolio in the New York Stock Exchange, maybe you've got a holiday home in Portugal. The South African executor has to be responsible for everything. And in my experience, they're really not qualified for that. So what's best practice is to have a will in each jurisdiction where you have assets, whether that's financial assets or fixed assets. So, I mean, these days, obviously, if you do travel to those countries, you can meet with someone when you're over there to draft the will. Or these days, it's not too difficult to have virtual meetings and get wills drafted offshore. So best practice is you have an SA will that speaks to your SA assets, and you have a foreign will or different foreign wills that speak to your foreign assets, especially if you're not using a wrapper and you've got fixed assets or you've got shares that aren't held in a wrapper.
Right, okay. I use ETFs for investments. Can these be transferred into a wrapper?
So yes, if you have foreign investments already, you can transfer them into a wrapper. You can essentially do a cash transfer, which is when you sell the assets and you cash them in and you take those proceeds in that currency and you open a new wrapper account for yourself where you would reinvest into your new portfolio. Or you can do a script transfer of shares or ETFs into a stockbroking account that can be held within a wrapper. It's a little bit more complicated to do that. I think the major point is that when you're moving from investments that you own in your own hands and you're moving to a wrapper, is that it's still seen as a tax sale, even if you don't dispose of the assets technically, because the owner is changing hands from the investor as an individual to the institution that's going to hold the assets with you being the contract holder. So you can transfer ETFs, but you're still going to trigger a capital gains tax event. So what we see much more commonly is just sell your existing portfolio, take the proceeds, and put it into a new portfolio. If you want the new portfolio to look very similar to the old one, that can be accomplished quite easily.
Right. Can a living annuity invest in an offshore wrapper?
So no, it can't. A living annuity is its own type of investment vehicle. It's also a long-term insurance act vehicle, but it's obviously funded by retirement funds that sits in South Africa. And a living annuity has its own rules. So these days, living annuities can invest 100% offshore, but you have, because it's a product that's based in rands, as well as it pays its income in rands, you have to invest in rand-denominated offshore assets. You can get quite clever with using asset swap facilities to buy feeder funds or shares offshore within a living annuity, but you can do that within the living annuity itself. You don't have to move it to a wrapper. So short answer, a living annuity can invest offshore, but you don't need to use a wrapper because a living annuity already is its own investment vehicle.
Right, thanks, Stuart. Can funds be, or donated funds be invested offshore?
Yes, so you can have donated funds invested offshore. I'm assuming that's donated from an individual to another individual, or potentially from an individual to a trust. I think the normal donations tax rules apply. So if you're donating as a spouse to your spouse, you can donate as much as you like to your spouse without paying donations tax. So that's something that's quite commonly done. If you want to, let's say, take 20 million rand out in a year, you can have one person who's actually got the capital, and then they donate half of that to their spouse, and each spouse takes out 10 million rand in a calendar year to be invested offshore. If you had to donate to anyone else, whether that's your children or a trust to invest offshore, you can do it, but just beware of donations tax. Because donating, the donations tax is 20% up to 25% if it's to someone who's not your spouse. So you can do it, but just be careful around any donations tax implications on that.
Right, all right. Last one. Can you have a joint account or an account where the surviving spouse and children are beneficiaries?
Yeah, so that's what's quite nice about the wrapper. You can do it different ways. You can draw it up similarly to you would your own will, in that you can have a joint account as spouses, where essentially if one of you pass away, the other spouse just automatically carries on with that. We've unfortunately had a few cases where clients have passed on, and it's as simple as signing a change of ownership form that the surviving spouse takes over that existing contract, and that contract carries on. And there you can have primary beneficiaries and secondary beneficiaries. So you could have children, grandchildren, trusts, whomever you would like to be your beneficiaries. If you don't want to have a joint account, you could just open the account in your name as an individual, nominate your spouse or your trust as primary, and whomever you like as secondary. So just like your will, you can do your various levels of who gets the money at different, points. Basically, if everyone's passed away, whether that's owners, beneficiaries, etc., then it just becomes an asset in your estate that your estate would deal with.
Okay. Wow. Thanks, Stuart. That was a lot we went through. Well explained. If you have other questions, please feel free to send them through to us. Just really want to go through just some of our core services. I think it's important that we do financial planning, that's holistic advice, life goals and family needs, investment management. We do active portfolio oversight, focusing on long-term performance. We have a separate unit trust that I manage myself called the Prosperity Fund. Direct offshore, as we've just been talking about now, which is the wrapper. The wrapper is, if you've seen, there's just so many benefits to it. I've got one personally myself. I always think it's a no-brainer. And then the tax structuring. And I think that's a really important part of it, where we tax structure your investments and your income in the most tax efficient way. And it's actually amazing how much you can actually save in tax by allocating the right assets into different products. Of course, products are taxed differently between retirement products and discretionary products and endowments. If you put the right asset allocation amongst them, you can get quite an improved tax efficiency. Then just from a value add perspective, Investonline, we're well qualified. We work as a team together, with lots of experience, proven track record of over 30 years in investing. Everything's completely transparent with us, cost-effective solutions. We break down all the costs in absolute detail for you to see. Obviously, it's a personalized service, and we've got a very strong admin team behind us. And we stress we have regular meetings, and that's always the big bonus of investing with Investonline, or the virtual meetings that we have. We feel we spend a lot more time with our clients doing meetings, video meetings. Obviously, we come up to Johannesburg as well to see some of our clients up there as well. Right, well, thank you everybody for joining us. Our next webinar, 21st of October. This is a great one. It's with Coronation Fund Managers. We're going to have a couple of their fund managers talking about the AI disruptions and emerging market opportunities. Please go register for it, and we look forward to seeing you on the 21st. Thank you for joining us.
Whether you're approaching retirement or already there, plan your future with clarity and precision using our most advanced financial modeling tools. One of our planners will guide you through your income, living costs, and goals like holidays, vehicles, and other big purchases. The key is an independent review of your portfolio's performance and fees, plus guidance on tax, estate planning, global investing, and more, all tailored to you. For over 15 years, we've been the bridge, helping South Africans achieve their desired lifestyles and growing their wealth locally and offshore. Book your free online session today.